go ahead and get started.
Well, welcome everybody. We're going to get started here this morning. Thanks for joining us. We're excited to have you with us. My name is Roy Heffernan, and I am a volunteer with SCORE. And I want to just cover just a few introductory items before turning things over to our facilitator today, Mr. Jim Danhauser. So I'm just going to share my screen here and talk through a few things. You see listed on this slide the organizations that provide assistance to us in presenting this webinar. We're supported by the Cape Cod Chamber of Commerce and the various chambers of commerce located on the Cape and the islands, as well as by the Community Development Partnership located in Eastham. As always, we're grateful to all these organizations for their ongoing support of our educational programs. For those of you who are not familiar with SCORE, we are a fully volunteer nonprofit organization and a resource partner of the U.S. Small Business Administration. SCORE's mission is to foster vibrant small business communities through mentoring and education. SCORE has been doing this work since its founding in 1964. Through educational opportunities like this webinar, as well as by providing mentoring to people who are in business or are thinking about starting a business. We benefit from having more than 50 volunteer mentors and subject matter experts serving in our chapter here on Cape Cod and the islands. People who have a broad array of differing career experiences and expertise. The same holds true for all of the other chapters in our Massachusetts, Rhode Island district. And we can connect you with SCORE volunteers throughout the country so we can match you with someone with the right experience to be of help to you. If you want to pursue this mentoring help, which is completely free and absolutely confidential in all matters, there are a couple of ways to proceed. You can go to the SCORE National website, www.score.org, and click on the Request a Mentor tab from the drop-down menu under the Find a Mentor tab. Enter your zip code and then proceed. Or you can go to the website of the individual chapter listed here that covers your geographic area and follow that same procedure. Finally, today's procedures, all participants other than our facilitator have been muted. And we ask that you enter any questions or comments that you might have into the chat bar, chat link at the bottom of your screen. We will answer as many questions as we can get to during the course of the discussion. Be aware that the webinar is being recorded, and we will send the link to the recording to all who registered for today's session once the recording is available. And now, and most importantly, I'll turn it over to our facilitator. So Jim, it's all yours.
Thanks, Roy. You need to stop sharing. There you go. Okay. Thanks, Roy, and good morning, everybody. My name is Jim Danhauser. I'm a volunteer mentor with the Cape Cod and Islands chapter of SCORE. And I wanted to talk today about the elements of a successful exit strategy for a small business. By way of background, I started my career as a business attorney with a law firm in New York City, then moved into investment banking as a financial advisor to businesses looking to accomplish acquisitions and dispositions. And then eventually became a director of several public companies and a chief financial officer of one of them. After that, I spent some time as an advisor to a large private equity firm and made several investments of my own in small businesses together with a partner, most of which we have successfully exited from. Since I retired, I've been a SCORE mentor since 2013. So that's a long-winded way of my saying that I've seen the life cycle of small businesses from a lot of different perspectives and have observed up close on a number of occasions just how critical a well thought out plan is to a successful exit from a small business. So let's go ahead and get started. And please, as we proceed, do put your questions into the chat as they occur to you. One of the negatives about doing these kinds of sessions virtually is that you lose the in-person contact dynamic with your audience. If you pose the questions into the chat as they occur to you, I can answer them in a timely fashion and at least restores some of the dynamic of an in-person conversation. So let's look first at what I consider to be the key considerations you ought to bear in mind when you're thinking about your exit. First, it's absolutely imperative that you start early. No one successfully exits from a small business by waking up one day and saying, I'm done. You can't accomplish that in a successful fashion. You have a lot to think through, much of which we'll talk about as we go through today's discussion. And it takes some time to get all of the moving parts accomplished. You need a plan. And like all good plans, it should be in writing and should not be done and then stuck on a shelf and forgotten. You should pull it out from time to time, think about it, reflect any changed facts and circumstances to make sure that you're thinking properly about the way that you're going to achieve an exit. In fact, in my view, you really ought to start thinking about this well before you're actually looking to exit. Think of it this way. Your business is likely to be the most significant of your financial assets. If not, it's among them. How will you realize value for that when you step away? In addition, even before that, who would be a successor to you if you were forced to step away from your business for a period of time or longer? You might have a family member involved in the business and hope that he or she would like to take over for you when you have to step aside. Well, you ought to talk to them about that and find out if, in fact, that's what they want. If it isn't, far better that you know that early rather than finding out when it's too late. If it is, then you ought to start training them for that, to be able to step into a leadership role effectively. Involve them in your strategic planning. Involve them in your budgeting. Let them understand your thoughts about the business, expansion opportunities, lending relationships, and all of that so that when you do step away, they're ready to step in effectively. And the same thing is really true if you think that there's a key employee who would be your successor. Second, you would be very well advised to have a proper valuation of your business done and kept up to date. I've seen a lot of business people over the years who think that they know what their business is worth. Quite often, they're just wrong. True business valuation is complicated. Businesses typically trade at some multiple of cash flow or earnings. Sounds simple enough, doesn't it? But that multiple can vary significantly by industry and geography. And even within an industry and geography, multiples can vary materially based upon factors like consistency of performance, required investment levels, size, growth opportunities, competitive landscape and changes in it, and others. So given how important this asset really is to you, you owe it to yourself to have an experienced outsider give you a valuation so you can have some reasonable expectation of what you could actually get on an exit. Now, you may have an accounting firm and think that they could do it for you, and that's possibly true. But in my experience, most accountant firms for small businesses are really good at tax returns, tax planning, financial statements, helping with budgeting and cash flow forecasting, but have not really developed an expertise in valuing businesses. You're far better served to use an experienced firm that actually does valuations for a living. And you can usually get recommendations for those in your market, either from your accountants, your lawyers, or if necessary, you could talk to a SCORE mentor for a recommendation. Third, your planning needs to take into account your personal and financial goals and needs, as well as those of your family. What do I mean by personal goals? Well, what are you and your family's members looking to do when you step away from the active running of your business. It's a 24/7 operation, as we all know, but when that's done, you're suddenly going to have a lot of free time on your hands. Well, how are you and your family members going to spend that time? Most people that I've known have quickly found that they need to find some other source of activities for themselves to keep themselves going, whether that's volunteer activities, contributing to local activities, recreational, or the like, or even picking up another small consulting business. But you need to think about how it is that you're going to spend the time of your retirement. And this is a discussion you should be having with your family members. Because now most people have a significant period for their retirement, and you need to be productively thinking about how you're going to deal with that. Just have honest conversations with yourself and your family members about this, including family members involved in the business. And your financial needs are very important too. What resources do you have? What do you need? Can you afford to step away? Will you need ongoing income? This may all dictate whether you need to stay involved in some consulting capacity for a time or find other income producing opportunities. And my experience is often very helpful to consult with an independent personal financial planner. They can really help you to think through what you're really going to need to support the lifestyle that you and your family would like to enjoy for what will hopefully be a very long period after you exit from your business. Fourth, as the saying goes, all battle plans survive until first contact with the enemy. So have a contingency plan in place to deal with things should your exit plan be interrupted for any reason. For example, you may have a planned sale, and that sale may fall apart. Well, you'll need to very quickly re-engage in the business, reassure customers, employees, and suppliers and lenders, and make sure that things keep going forward on a positive basis. Fifth, if you have any partnership or shareholders agreements, make sure you understand the implications of those documents for your exit, whether that's by sale or otherwise. For example, there may be limitations in those documents on your ability to sell your ownership interest, or you may be required to sell your partner's interests together with yours, or they may have a right of first refusal to buy you out. These can be complicating features. You need to make sure that you understand their implications for you, and it's probably a good idea to consult with an attorney to make sure you understand those correctly. Roy, do we have any questions that come in yet?
Yes, sir. Jim, you want to take one right now?
Sure.
What about considering becoming less of an operator and more of an owner? Letting go some, but not letting go altogether. How do you determine if that could be a viable option?
Well, the first thing that will help to determine whether that's a viable option is an analysis of who in your company would take over the key operating roles. It's perfectly fine for you to step back and remain in your full ownership position, so long as you have a good successor in place. And that's what I was really talking about when I talked about either family members involved in the business or key employees. It's a very viable thing to do if you'd like to, and to make sure that you have the right people in place to take over. But recognize that it's really difficult to make the transition from somebody who calls all the shots to somebody who's really just going to be an owner and watching other people make all the decisions. If you do that, you have to be sure that you keep a tab on things, but that you don't micromanage, because otherwise you won't have accomplished anything. But if you have a good management succession behind you, then you can certainly do that. And then you need to think about how you incentivize those people. It's not just with salary and or bonus. You may need to provide for them some equity participation as well. Anything else, Ryan?
That's it right now, Jim. Thank you.
Okay. All right. So those are the key considerations that you ought to be thinking about. We'll talk now about the 5 key steps to planning your exit. You need to set a target date. You need to discuss your desire with key people. That'll include your family members, advisors, etc., to get feedback. With that in hand, you're going to create the plan or modify the plan that you already have in mind based upon that feedback that you receive. Once the plan's in place, you need to communicate that plan, again, with family members, key employees, personnel, professional advisors, etc., and then you implement the plan. And I'm going to discuss each of these in more depth as we go through the rest of the discussion. Step one.
Jim, can I interrupt?
Sure, always.
We've got another very nice question. This one from Denise. It's we struggle to identify parallel businesses, and she's talking about parallel businesses to her marijuana detection business. The public understands Breath and investors have financed these groups, but Breath cannot detect edible marijuana. Right now, we are looking at experts in the alcohol technology industry. I'm not sure there's a question there. Denise, can you elaborate on what the question is? Are you looking for help to identify parallel businesses? What about that, Jim? Do you have some thoughts in terms of her struggle to identify parallel businesses relative to breath versus edible?
Well, it's a very specific question. Finding parallel businesses is always a challenge for growth. It doesn't really deal with trying to exit, except that you might be trying to expand your business to make it more attractive to somebody who would purchase it. The only thing I can recommend you do is do as much research you can as to emerging technologies. I'm happy to say that I am not an expert on either inhaling by smoke or edibles, but I realize that it's a very viable and growing business, and detection is going to be increasingly important to law enforcement agencies. So one thing I would think about is actually seeing what the law enforcement agencies are trying to do to enhance their ability to detect the influence of edibles, which do not have the same odor impact that smoking would do.
Okay, so Denise has really helped us here, Jim. We're looking for professional guidance and valuing the business. We have a technology, we don't have sales, and don't think she has patents either. So she's looking for professional guidance and valuing the business.
Yeah, got it. Okay, that's helpful. Well, as I said, in terms of valuation, it's a pretty specific skill set.
Jim, sorry, they have 3 patents.
Okay, well, that's great because that's a significant part of your value. Is that patents pending or patents actually granted? Because there's a difference. Patents pending means
actually in place, Jim.
Oh, that's great. Okay, that's a real value enhancer. I would suggest very strongly that you talk to people in your market in terms of attorneys, advisors, and if necessary, look to your local SCORE chapter and talk to a mentor. They can advise you about people who are well positioned to provide you an appropriate valuation for your business, in particular based upon the patents that you have.
Great. I love this interaction, Jim. We're going to ask you another question if you're ready for one.
Sure.
In general, is there a minimum annual sales revenue and/or net profit margin before a company is considered sellable?
The answer is that all depends upon the company, the industry, the growth rate that might be in front of it. There's no set number. Obviously, the simplistic answer would be the higher, the better. But at a certain beginning stage, you're really not looking to sell the business. You'd be selling an idea. And most of that comes by way of attracting investment into the company as opposed to a sale of the company. But I have seen companies of all sizes get successfully sold. It's an effort. You need to find somebody who's prepared to undertake it in terms of a business broker, which we'll talk about later. But by all means, if you have a viable business idea, which has the possibility of real traction in an attractive industry, you can get bought. You see that all the time, particularly in the technology field, where what we call acqui-hires, where a bigger company will buy a smaller company in part for the technology, but just as much for the people. So I don't know if that's particularly helpful to you, but the answer is there's no rule of thumb as to the level of revenue you have to have or the profit margin that you need to achieve. It's all going to depend upon the industry, the attractiveness of any growth potential, whatever moats you may have around you. That is to say that how you have a controlling, compelling position to protect your market status. And then you got to work at it. You work at it either by seeking investors or you work at it by trying to work with an aggressive business broker who would look to sell your business. Okay, so step one, set a target date for your exit. Note that this may entail a sale of the business or you're stepping away without a sale, as we were talking about before, moving into more of an ownership position as opposed to an operator. The timing of this is going to be influenced by a number of factors in addition to your desires. It may be influenced by market and business conditions. Harder to step away in a downturned economic environment or when a major competitor has come into your marketplace. You need to be realistic about what's achievable, but you should have a target date, if nothing else than to provide a deadline against which the process will move, because otherwise it tends not to. If you're planning to sell, take a little time to think about whether there are some easy steps that you could take to improve the business in anticipation of an exit. For example, you may have some near-term growth opportunities that you could accelerate to improve the outlook of the business. And you should also make sure that you organize the business and financial records of the company. Things like financial statements, tax returns, leases, major contracts. Why? Well, a potential buyer is going to want to come in and look at that as part of their due diligence process. And if you have that in an organized fashion, it gives a much better impression about the capability of management and the condition of the company than if things are scattered all over the place in a very unorganized fashion. I've just seen it happen time and again. You get a much better reaction from a potential buyer if you present to them an organized overview of what the business is. Most importantly, you should have a clear understanding of your financial plan and what a sale would mean to you. What does it mean for you and your family from a financial point of view? Are there debts or buyout requirements that will limit what you get on sale? What about taxes from any transaction? Because these can vary significantly depending upon the form the deal takes. You may get a consulting payment, which would not be capital gains, but would be ordinary income. It can get very complicated, and you owe it to yourself to understand it and talk to your accountant about it. Well, you need to have supplemental income to get you through your retirement years. And we've talked about that a little bit already.
Jim, we got another question here. You ready?
Sure.
Okay, so so Jody has a question here. She has a goal to transition to selling her business in 2 years. And she gives you some background. So I'm going to read that to you. I'm considering selling my business. We provide professional development for early education and care and out-of-school time programs, as well as observations and coaching for Head Start using required tools and coaching for directors, as well as having state grants. Our product is 75 plus CEU approved courses available online or in person. We can transfer our international CEU certification to another agency. We are an IACET accredited provider. I did have a review done at Clark University on the value a few years ago. I hope to sell. I am the sole shareholder with 3 part-time staff. My question is, how do I get the word out there I am interested in selling without hurting business or losing staff?
That's a challenge that everybody has when they think about selling a business. Obviously, if you're in the position of being an agent, as I was many times trying to sell a business for somebody, confidentiality was always a major concern for its impact on the business, employees, et cetera. Here's the challenge. You can't effectively sell something by whispering in the wilderness that it's for sale. You need to have conversations with likely buyers. And you need to try to impress upon them the confidentiality requirements. But there's a real risk that word will get out. So you have to balance the risks. I would not, in that circumstance, try to launch a broad effort through a business broker of trying to contact every imaginable potential buyer. But I would spend some time thinking yourself about who would be the likely buyers, and then try to identify who it is that you could have a confidential conversation with, and then be prepared for the blowback, because it's really hard to make sure that you keep everything confidential. And by blowback, I mean, you're going to try to reassure your employees if they get nervous that, in fact, you're looking to sell the business to make sure that it is in good shape over the long haul. You're not looking to sell it to somebody who's going to come in and cut staff and eliminate services. It's the best you can do.
And
But
Jim,
otherwise, you're going to be sitting there owning it forever.
and Jim, once you've kind of zeroed in on potential buyers, you can get confidentiality agreements in place that do have some teeth and can try to protect you during the course. I know it's tough.
You can, but you're not going to get to that stage until you've actually had some conversations with a potential buyer. So you've run the risk anyway. And the second thing I'll tell you is that, yes, you'll get confidentiality agreements and non-disclosure agreements, but they're worth the paper they're printed on. People may respect them and they may not. And if they don't, the damage is done whether you try to sue them to enforce them to stay confidential or not. So you have to hope that people will respect those. But you're not going to sign that kind of an agreement until you've already had some preliminary conversations. And so you run the risk that you were talking about before. It's why the best you can do is control the process as well as you can and try to identify the particular people who would be most interested in buying. I think the other challenge you have in that particular field is the uncertainty right now, given all that's going on in the nation's capital about grant funding, Head Start programs, et cetera. So realize that if you try to do something now until there's clarification in that, you will likely take a significant hit in the valuation that you'll be able to achieve. So I would suggest that this would not be the best time to do something, at least until there's more certainty that comes out of all that is going on currently. Okay. As you begin to formulate your plan, you're going to have multiple discussions with others as it begins to take shape in your mind. This, of course, includes family members, including any involved in the business, but it should also include any partners in the business, as well as key employees. You want to be sure those employees are comfortable with your plan and are assured as to its impact on them, as they'll be key in maintaining business performance. Now, stress the need for confidentiality. You don't want to have lots of water cooler conversations going on. So discuss it really only with the very key employees that you can absolutely trust will be confidential. And if you don't have any, then don't talk about it at this stage. Obviously, family members who are involved in the business will be important as well. But stress importantly the need for confidentiality. And if you are not confident yourself that people will respect that confidentiality, then don't talk to them about it at this stage. But you should have discussions at a minimum with key advisors. This includes your attorney, your financial advisor, and your accountant. And don't forget to consider, if you're selling the business, a conversation with a competent estate lawyer, because they may have input as to how you can best structure a transaction to preserve ultimate value for your heirs. who hopefully will be waiting a long time to get any value. Step 3, create the plan. Now, this is really just trying to finalize your plan based upon all the discussions that you've had in step 2. Now, quite often, as we've discussed, an exit strategy will involve a change in the ownership of the business. There are various ways for this to be accomplished. They'll have different timetables and different consequences for you, and you should consider the alternatives to make a decision about what's most realistic for you in the circumstances and has the best consequences for you. The typical options are listed here, but most often for small businesses, it's either going to involve a sale of the business as a going concern or a sale of assets, including contracts and liquidation. There are also, as we discussed, exit strategies from operations in which you don't have a change in ownership. And that's a perfectly viable route as well, so long as you have a viable successor and you have the financial wherewithal to defer realizing value in a significant way immediately upon your exit. So a sale of a business as a going concern can be in one of several different possible forms. You may sell the business to family members or make a gift in whole or in part. You could sell the business to key employees, and we'll talk later about a couple of different vehicles to accomplish this in the event that employees don't necessarily have the wherewithal to pay for an outright sale. Oftentimes, in either of these kinds of transactions, some or all of what you get is going to be in the form of a promissory note for future payments and or deferred payments for consulting services or based upon business performance. These can have different tax consequences for you that you need to discuss with your accountant. And of course, recognize that you're then taking the risk of the future business performance to generate the cash that is going to make the payments against that note or the deferred contingency receipts that you're entitled to. And if it doesn't work, you may find yourself having to decide to step back in order to protect your deferred payment stream. So you just have to be comfortable with that, or be prepared in the event to say, okay, it didn't work. I'll take what I got and be done with it. But that's just a risk that you have to be cognizant of. Now, a sale to a third party could be a sale to a strategic partner or to a financial buyer. Now, by strategic partner, we generally mean someone who is in business already and looking to add your business as an additional outlet for themselves, or they're looking to buy your business to become the operator. An example might be somebody who runs a hardware store and is looking to add your hardware store as an additional outlet. A financial buyer is typically an investor who is buying your business with the hope of improving it and then selling it or taking it public. Or they might be executing what we call a roll-up strategy. Not to get too investment banker wonky on you, but a roll-up strategy is where a financial buyer sets up a holding company and buys a series of businesses in a related industry, and with the hope of just getting economies of scale and ultimately taking it public. We've seen that, for example, with veterinary and dental practices around the country, where financial buyers are buying up a series of practices and operating them under one holding company. Again, some of these kinds of transactions may entail you staying involved for a period of time, either as a consultant or a manager. This can be a particularly tough transition for a lot of small business owners who are used to being the ones who call the shots. And suddenly they're not anymore. And you have to get used to that. But you also have to avoid being the one who all employees go to complain and moan about the stupid decisions that the new owner is making, because that's not very productive for you. And you need to be okay then with staying involved. And like the sales to family members or employees, you may need to accept debt as part of the sale or a contingent payment based upon future business performance. And all that needs to be evaluated against what the realistic alternatives are and what your needs are. a lot of times you'll see what we call a value bridge in the form of a contingent payment. What do I mean by that? Well, you think your business, based upon your conversation with the business valuation firm, is worth X. The buyer thinks your business is worth Y, which inevitably, in my experience, is less than X. Well, the way that sometimes that value gap is bridged is the buyer pays you X and agrees to pay you some extra amount over time based upon ongoing business performance. So that's a common feature that you will see in a lot of transactions. So just make sure you're comfortable with that. Most importantly, in my view, if you decide to sell your business, it's really good practice to use a business broker. These are people who sell businesses for a living. They can help you to make sure you're prepared for the process and that they reach out to the pool of most potential buyers, subject to your input as to where you're comfortable them talking and where you're not comfortable. They also only get paid upon a successful sale. But make sure if you go this route, which I highly recommend, that you deal with a reputable broker who is experienced in dealing with companies of your size in your industry and geography. And you can find those in most markets. You can talk to your lawyer or your accountant to get advice, or you could talk to a SCORE mentor who'll be able to give you some recommendations. And realize, as I talked about before, that once the process starts, it's really hard to keep it absolutely confidential. Word will generally leak out. You'll do your best to control that, including, as Roy mentioned, with confidentiality agreements and non-disclosure agreements. But in my experience, word still filters out. So you need to be prepared to have conversations with employees to reassure them as to its impact upon them, with potential suppliers, and with your lenders.
Jim, you ready for a question?
Sure.
My business revenue is under 1 million. It's about 850K or so. Most seem to only be interested in companies that have $1 million of revenue. Is that your experience too?
That all depends upon your industry. Obviously, if you're talking to a business broker, they're going to be more interested in the larger your enterprise is, because that they get a percentage of the transaction sale price as their compensation. So the bigger, the better. But you can find others who would be interested in buying a smaller business. You may need to work at it. How do you do that? Well, think about finding other companies in a related industry. Think about finding potential investors into your business who would be interested in buying a part of it and then buying the rest of it over time. You need to work the case to get there. It's not easy, but it matters to you, and that's what you ought to be trying to do. The other alternative may be, instead of selling off your business as a going concern, to do a sale of your assets and then just wind up the business.
We have a couple of people, Jim, that hopped onto your comment about brokers taking a percentage. What is a typical percentage of a broker helping you out in that regard?
That'll vary all over the map. It can be as little as 2.5%. It can be as much as 7.5%.
Good. I think that'll be helpful for them to understand the low and high. Good.
But what you ought to do is make sure that you research that. You don't want to necessarily just get the cheapest broker, because they may be cheap for a reason. I have this discussion with people all the time. Sometimes you get what you pay for. You don't want to overpay, but you want to make sure that you're paying a market rate, and you can discover that market rate by doing your research. And you want to make sure that you are not necessarily dealing with somebody who is just running what I call the Craigslist of business sales, in which they just list things and send lists around to a whole a constant contact email list that they have generated over the years. You want to deal with a reputable broker who is charging a fair rate, who has relevant experience, and will run a good process for you. But back to the sale of assets, you may, for example, run a retail outlet, and you have a good lease in a good location, but you just don't want to continue to do it. Well, instead of trying to sell the business as a going concern, you may be better off finding somebody who wants to run a different operation, take over your lease, and you sell off your assets and just wind up the business. Similarly, if you have a service contract, like a landscaping service, you may be better off just getting somebody else to pay you to pick up the contracts that you have, sell off your equipment, and winding it up, as opposed to trying to sell the business as a going concern. This is all very situational and underscores why you need to have some real conversations with experienced professionals to outline what the realistic alternatives are for you in the circumstances. And we've helped a lot of people in this regard at SCORE. So if you do want to pursue that, you can talk to a SCORE mentor in your local marketplace. Now, in addition to those alternatives, you might think about trying to merge with another business. That involves you combining your business with another business. Typically, you get less cash upon the transaction, and most of your consideration is going to be an equity interest in the combined enterprise. So you'll have less cash, and that may influence your ability to do this based upon your financial needs and requirements. You're also likely to have some restrictions on your ability to sell the equity in the combined entity on a going forward basis. Those would need to be negotiated, and you need to take account of those in your financial planning. But it can be beneficial from a tax perspective because it delays the day of reckoning for paying the taxes. Other option is going public, but that really requires some significant expense in terms of lawyers, accountants, and others, and is really usually only available to larger enterprises. And now you see some acronyms here. They're ESOPs and EOTs. I'm not responsible for the acronyms, they just exist. And I almost hesitate to spend any real time on this, but it's worth just mentioning to you so you know that their existence. An ESOP is an employee stock option plan, stock ownership plan. What that is, you set up an entity that will, over time, you'll contribute stock in the company into. And then when you're ready to exit, you would sell the balance of your stock to the ESOP. You might, in the more likely, have to take a note back from the ESOP for that sale, or the ESOP could borrow some against it and give you some of the proceeds of that bank loan. These were popular for a period of time, but for most small businesses, they're really difficult because they are expensive to set up. They're highly regulated. They're ERISA plans. It's Employee Retirement Income and Security Act plans. And you may spend $50,000 to $100,000 to set it up. It's a great tool to incentivize employees, but it's not inexpensive. There's been a more recent development of this thing called EOTs, which is employee ownership trusts, which is actually, it started in the United Kingdom, and they've come over to the US more recently. Unlike the ESOP, these are not regulated by ERISA. You set up a trust. The employees do not end up owning stock. They end up having a beneficial right to distributions from the trust of whatever cash the trust gets from the business. Again, you would transfer stock in, and then when you're ready to exit, you would transfer all of your stock in and get either a note and or a combination of a note and bank borrowings that they can make. These are less expensive to set up. They can be useful tools to incentivize employees and help you to retain employees. And if you have any interest in exploring them, I strongly recommend that you discuss this with an experienced attorney because they can be very expensive. You can drill a lot of what we call dry holes and get nowhere. But if you have good employees that you'd like to figure out a way to structure a transaction with, these can be a way to accomplish that. Step 4, communicate the plan. Actually, this is really just continuation of the communication process that you should have been having with key people all along while you're trying to finalize the plan. But now that you've got a more final plan in place and have a good, clear idea of exactly what you're going to try to do, it's appropriate to have further, still confidential discussions with key employees and family members and solicit their feedback. Recognize that the key management, including family members in the business, will be really important to the continued smooth operation of the business as this process unfolds. And you need to make sure that you do your best to reassure and incentivize them, because you're introducing uncertainty into their lives. Their ongoing relationship with other employees, including if you have family members involved in the business, is going to be a challenge, and you need to help them to grow into the new role that you see for them. And by now, you should know if any of your family members who are in the business want to stay in it, but double checking again is a good idea. And now you finally go to implement the plan. Your plan should already reflect input from key advisors, including financial planners, lawyers, and estate planning professionals. But as you prepare to implement it, a final check through with them is entirely appropriate. And assuming you're going to look to sell your business, this then becomes a process that you need to actively manage. You can't just turn it over to the business broker and outsiders and say, okay, guys, go do it and call me when it's done. It's far more important to you than it is to them. So make sure that you manage this just as you manage your business, with target dates, active reporting, checking in, making sure that things are going as they were expected. Having retained a business broker, as I said before, you're going to get together with them to map out how the process is going to play out. And you're going to make sure that you prepare a set of records and key documents for potential buyers to review. And you're going to end up negotiating the terms of a deal. So get together with your attorney in advance to think through the key terms and prepare for those to be negotiated. This will include, if it's a sale, things like price, payment terms. Will you accept deferred payments? Structure. Will there be non-compete agreements? And how are you going to handle the transaction, the transition, and many other things? If you have partners or investors, you need to take their positions into consideration, especially if you have agreements in place that have any impact upon your ability to sell your position or what happens with the overall proceeds. So by now, you should have experienced counsel on your side to help you to deal with that. And prepare for the transition. Think about the communication of any transaction to the various interested parties. This will include employees once a transaction happens. It will include customers and suppliers. And ideally, that's going to be crafted together with the buyer. And this is particularly important if you're going to be taking a contingent payment stream based upon future performance. For example, I have a good friend who sold his financial advisory business. Well, one of the requirements of that deal was that he sit with his clients and the new people who would be running the advisory business so that the clients could get comfortable with them and very quickly get to a stage where they would not have the risk of moving their business elsewhere. It worked out very well, but that's because there was a smooth, clear transition plan put together in concert with the new owner. And even if you're not doing an outright sale, but doing a change in your position with respect to the company, you want to make sure you have a good communication plan in place for everybody who's involved, employees, suppliers, and lenders, and customers. There's also other steps that you're going to want to take, including making whatever changes need to be made to corporate documents, bank arrangements, and the like. It's always the case that clear communication as to exactly what's going on is an essential element to having a successful exit. So, Roy, are there any other questions for us?
Well, I'm going to give it about a few seconds here, see if one drops in, but right now, yeah, it looks like we've got one here. You ready, Jim?
I sure am.
Is it ever a good idea to not be confidential? Say you are ready to retire and everyone knows that's on your mind. You have a local business that is part of the community. Does it ever make sense to spread the word to see who might be interested?
Yes, it does. In fact, I recommend strongly, if you're comfortable that it won't have a negative effect upon your business, that you communicate broadly. It's a natural evolution for you to accomplish an effort to exit. And there is no reason why you should be shy about it. It is your business. And you may well find that there are people who would be interested that you wouldn't have expected would be interested. So I'm all in favor of broad communication, so long as you are confident that you understand the potential impact upon your business. So before you launch that, you want to make sure that employees understand. You want to make sure your customers understand. You want to make sure your lenders understand. And you have a plan. Your plan is that I'm looking to find someone who will step in to take over my business. And the business is going to continue to run as it did before. But with that plan in place, absolutely, if you have the broader conversations you have, the more opportunity there is to find somebody who actually is going to have an interest in stepping in.
That's about it, Jim, I think, unless we've got a last minute question. You're welcome to drop it in now. Otherwise, I think that's it on the questions.
Awesome. Well, listen, thanks everybody for joining. I hope you found today's discussion to be of value. I know we covered a lot of different territory, and my parting advice is that it is all very situational. Everybody's position is different, but everybody has a need eventually to consider how they're going to exit from their business and what's the best path for them. So the best thing that you can do is talk about this with advisors that you trust to get their perspective as well. So again, thanks for joining, and I look forward to talking to you at our next occasion. I'm going to close it down now. Thank you, guys. Thanks, Roy.
Thank you.